DeFi Slate team.
What's up, y'all? Real quick, if you like the DeFi Slate content on Twitter and YouTube and Substack, please give us a like and a subscribe on this video on YouTube. Join our channel, join the community. We'd really appreciate it. We're pumping this stuff out for y'all as much as we can, and we really enjoy the support and the community that we've built. Thank you very much and enjoy.
What's going on, guys? Welcome to episode 36 of the DeFi by Design podcast. I'm here today with Robbie. We're actually in the same room for once. Robbie did a bit of traveling from Florida up to North Carolina. So we are here hanging out, kicking it back. Excited to talk today with the team over at Liquity. It's a bit of a tongue twister there, but it's amazing protocol that we did a demo with that you guys should check out on our YouTube if you haven't seen it yet. We showed you guys how to earn yield on ETH. So it's definitely something that a lot of people are starting to come around to as far as ETH being a productive asset. So I'm going to turn it over to Robbie, see how he's doing, and let's get it off the table, baby.
So it has been a super fun weekend, and it is now Monday, May 17th. And today we are talking to the guys over at Liquity. As Andy mentioned, ETH can now be a productive asset. You can stake your ETH to earn rewards. This isn't just something that is possible with ETH 2.0, right? When gas fees are starting to get transitioned to proof of stake rather than proof of work. We'll talk more about that, but Liquity gives you the opportunity for APY just in a staking contract, nothing to do with blockchain costs or transaction rewards. So I will pass it over to Colton and let him explain how he got started and what he's doing over at Liquity.
Yeah, sure. But before we go, I'll pass it to Robert first. He's the CEO and founder. I'll let him kind of tell the story of Liquity, and then I'll introduce myself afterward.
Yeah, so Liquity is all about borrowing, and it's a decentralized borrowing system that I came up with while working at Dfinity like a while ago, and that was mainly because I started looking into the DeFi space, which was around 2018, consisting mainly of MakerDAO and Compound and a few others. And just while looking into those mechanisms, I realized, oh, hey, that's super cool. You can build a stable coin and based on borrowing, but somehow this is all a bit inefficient because, the way they liquidated the positions, the borrowers who are under collaterals wasn't exactly optimized for speed and efficiency. So that's how the whole idea came about, that maybe we can do liquidations in a different way by making them much more faster and thus more efficient. And at some point I decided, like it was in November 2019, to fully focus on this project, and I quit and found my co-founder Rick Pardo. He's based in England or Great Britain, and he is now our lead developer. And we launched this now 6 weeks ago, and I guess it was a success, if I can say so. And I'm happy to tell you more about the story, but maybe I let Colton take it away here.
Yeah, I'm Colton. I'm the head of growth at Liquity. I joined like three and a half months before launch. Before that, I was at the Stellar Development Foundation doing ecosystem and community growth, and ended up being introduced to Robert, and we hit it off, and ended up joining the team and helped lead Liquity to launch. And since then, it's been a pretty exciting 6 weeks, month and a half or so. The protocol has grown to, I think it's over 3 billion total value locked now. And then the stablecoin LUSD that, is generated from that total value lock has grown to a market cap of around 1.4 billion. It's now the, I think, 6th largest stablecoin in the space. And that's only after 6 weeks. So hopefully there's a lot more room to grow.
Sweet. Yeah, that's awesome. Super quick launches, super quick growth, and just all of a sudden everything is just falling into place. What's been the thing that surprised you the absolute most about the launch, Colton? What caught you off guard?
Yeah, I think for us, what caught us off guard was like the speed at which everything happened, right? Like whenever we're leading up to launch, we knew that Liquity was really cool. We knew we introduced a lot of cool mechanisms, and we knew that people would resonate with them. We didn't know the speed at which people would resonate with all of those different features. I know when Robert was building this thing out with the team, even before I joined, they probably had no idea how people would sort of relate to some of the more unique features of Liquity, like no interest rate or the redemption mechanism, which is a bit strange. So there's all these different features of Liquity that are relatively unique, and so it's hard to know how the market is going to catch on to those. But for the most part, people have caught on pretty quickly. Robert, I don't know if there was any specific parts that were super surprising for you.
So yeah, I was surprised not just about the growth, but also about the stability. So I was a bit more maybe afraid that this could be a rougher start, because yeah, Liquid is really a collection of innovative things and new things that haven't been proven to work in practice so far. So I mean, it's first of all, it's like the fact that we have redemptions instead of interest rates. We also have a completely new redesigned liquidation mechanism when compared to other systems. But we also have this like decentralized front-end approach, which makes us a bit reliant on third parties to get to the customer in a sense. And then last but not least, like we also had this kind of extreme reward mechanism for our early adopters, like the stability depositors. They get a very nice, or they got like a very high yield on their deposits in the first few days and weeks, which could have led to some more extreme price movement because people may have wanted to buy more LUSD on the market, which could have pushed the price up, but that didn't really happen. So it seemed that the price is stabilized relatively nicely around $1. And this is almost like a positive surprise to me. I'm not sure about Colton.
Yeah.
Yeah.
Yeah. No, especially when you launch with a lot of incentives for effectively getting as much liquidity to your platform as possible. There's almost like a whole host of things that can happen. I mean, we've seen it all in the last few months, really. I'm curious kind of what your take is on fixed rate and fixed period lending and borrowing protocols compared to kind of like the perpetual style of Aave and Compound and Liquidity. Like, what's your take on integrating fixed rate and fixed period protocols into DeFi? In comparison to the other ones.
So specifically, when you look at Liquidity, it's already kind of fixed rate because you pay like an upfront fee, which is currently 0.5%, but it's not fixed time because you can leave your position open as long as you want. So the rate is clear from the outset, but like the time is totally up to the borrower. Yeah, we have seen like other protocols building those kind of fixed time, fixed rate products. I guess it's a good thing in the sense that like they're trying to accommodate the same market segment, which is looking for predictability, because it's just much nicer if you know upfront what you have to pay. Now, in our case, you know upfront what you have to pay, but you may not even know how long you want to keep your position open, while in other systems, you're basically obliged to repay maybe after a year or like within a certain time. So there, it's clear, but it's also kind of more restrictive. So we have this maybe middle way between the two. So you can, like the only uncertainty for your costs of borrowing comes from yourself, because it's totally up to you when you want to repay.
Yeah, and I agree. I think ultimately as the space matures, people have to figure out how to do fixed rate loans, because honestly, variable interest rate loans, especially for sort of medium to long term borrowing, just suck. Like you have no idea what your loan's going to cost you up front, and that's less than ideal for somebody who's trying to borrow so that they can productively use that capital elsewhere. So if you're borrowing from somewhere like Liquity, where you're just charged a 0.5% fee up front, then you can go use that capital elsewhere and know exactly how much you need to make back in order to sort of pay back, sort of recoup your fee and then pay back your debt. But if you borrow from somewhere else, let's say Maker, for example, that stability fee that you're charged via Maker can end up, costing a lot more than what you thought it was going to cost sort of 6 months after you took out the loan. And so there's a lot of advantages to knowing your cost to borrow up front. The only sort of trade-off that Liquity makes is that you eat that cost up front rather than eating it throughout the duration of your loan, like you do in MakerDAO or Aave or Compound, for example.
Yeah, one of my favorite parts of actually having a floating rate though is because when the rates go through the roof, there is basically it's been one of two things in the recent times. It's been either like a local top because everyone's borrowing and just going long, and it's just like, okay, I should probably de-risk some here. If everybody else is going heavy, I should probably pull back some. Or okay, what the hell is going on? What's the new stablecoin farm that is at 10,000% APY that everyone's just maxing out their health factors for?
Yeah, no, that's totally true. I mean, yield farming has played a massive role in the way that sort of interest rates have fluctuated, particularly on Aave and Compound. But at the end of the day, some of that stuff isn't going to be around, 2 years from now, 3 years from now, or the degree to which it's around is going to be a lot less, I think. And so, you could still have interest rates that are sort of signals to what's going on in the market. It might just not be in like literal real time, maybe in the same way that they are now.
Yeah, I totally agree with that. I guess those high yields, they will eventually have to come down because they are not sustainable. I mean, you cannot just give out a reward to your users forever. I mean, at some point, you're diluting the value that you can give to your users. But I mean, it's nice as an early adopter incentive, and at some point the market will mature, and then it will be more about the fundamental benefits that your system can offer over just short-term rewards.
Yeah, I think part of the benefit that Andy's mentioning on interest rates is it kind of gives you a signal into the rest of the market and kind of how levered up and risky everyone else is treating the market. We see that in like options trading a lot, like when options pricing for futures contracts tends to really go up because there's a high amount of expectation that somewhere down the line, Bitcoin or Ethereum, whatever asset you're trading options on, is going to rise in price. And then the same can be said for the downside. So I think having some insight into kind of how levered up the market is kind of tells you how frothy it is at any one given point. And then you can make decisions off of that. So, the fixed rate loans is definitely going to be a more mature ecosystem, but we might not get quite the insight into the rest of the market. And I guess what kind of levels of speculation the rest of the market is dealing with that we can derive from variable interest rates.
Yeah, I guess, I mean, you can derive some information from interest rates for sure. And I don't think that variable interest rates will ever completely disappear. I think they just cater to another segment of users, maybe users who are a bit more risk-seeking or just less, they care less about like predictability because they are fine with all those fluctuations, while there are other users who just want to put some money in and forget it and come back later. For those people, maybe a fixed rate product would be more interesting.
Yeah. Do you guys have any plans to endeavor into the infamous lands of under collateralized lending? And like, what's your thoughts on that as far as bringing that into DeFi? And real quick, I want to preface this by saying I think the fact that we don't have it available truly in DeFi yet has been a major positive thing, because I think it gets quickly abused within the system and is a cause of a run up of just a metric fuck ton of debt very quickly just because of just pure apes. That said, what's kind of like what's your thought process on that? And are you guys building anything towards that?
So we are not building anything towards that, at least currently or for the foreseeable future, but it happens to be the case that I had a chance to at least conceptually work on something similar, which is related to Dfinity. There's a project, there was a project called Phi, which is an early example of a non-collateralized lending project, even like it's more a bit similar to peer-to-peer lending on the blockchain, where you have a number of people who underwrite loans for like borrowers, and it's all based on legal agreements. Once you go under collateralized, you probably need to have some kind of legal agreement in place. Otherwise, why would anybody become a guarantor of a loan?
Yeah, credit or something, some sort of like reputational system on chain or something.
Yeah, but even with like reputational systems, you have like those exit scam risks. So I'm not sure if you have like it can build a reliable under collateralized borrowing system just based on like prior reputation. Maybe that would work from like a number of people who are already like quite famous in the space, who have something to lose their name, or I mean, if they don't repay, maybe just the negative publicity about them would be enough to give them credit and to make them repay their loan. So maybe it could work like in this like kind of narrow segment, but like for people who have literally no online presence, it would be very hard to get any backers, I guess. But maybe you have a different opinion on that.
Yeah, I agree that I think it'll be very hard just because like in the real world, a lot of stuff, all of the loans that sort of exist in the real world are collateralized by something. It's just what that something is super abstract and like really hard to represent on chain, whether it's like your credit score or whatever else, right? And so like moving that stuff on chain and then moving some of those legal agreements and like potential legal repercussions on chain is like a tricky thing to solve for. Though I do think like, as you guys mentioned before, there is like new risk that is introduced whenever you move to sort of under collateralized lending, so to speak. But I do think DeFi has the advantage that at least all of it's on chain, right? We could track where a lot of this stuff is going. We could track how the money is used. We could track how the loan's generated. And so DeFi opens up a level of transparency that solves for a lot of the issues that are caused in lending today in the traditional market, where a lot of that stuff is obfuscated away from sort of the normal person, or where a lot of the risks may be hidden from the normal person. That type of stuff is not hidden in DeFi, at least.
Yeah, I have seen some attempts at like a decentralized credit score for on-chain activity, but I still don't think that gets to like a solution for under collateralized loans. Because there isn't any point in trying to set up some kind of sort of law or just rule that you have to repay your loan when that's not enforceable kind of in the real world. You can't instantiate like garnishing someone's wages or foreclosing their house on chain. You just can't do that. I guess this is switching gears a little bit, but Robert, you mentioned Dfinity a couple times, and we've talked, a lot about Liquity. But could you explain kind of what Dfinity is, and how there's any interoperability or how it fits into the rest of the DeFi ecosystem?
Also, I mean, they just launched a week ago, and it's a completely separate system. But it also gives you a way of decentralizing your front end, if that's what you're maybe asking. So basically, it's even though it's this like a standalone system, it has this kind of nice feature that you could also just use it for hosting front ends, which can then communicate with Ethereum-based applications. And I think this is also something that the Dfinity team is pushing. I mean, it's like kind of a bridge, front end being hosted on Dfinity and the back end being hosted on Ethereum, for example, because it enables you to sign transactions and send them to like the Ethereum network in that sense.
Yeah, and I read a bit more about the internet computer that just kind of launched right up in the top 10, basically trying to bridging, traditional Web 2 kind of with Web 3 while ousting the current layers of AWS and such that we have currently, kind of similar to Pocket. Overall, a huge niche that is really it's going to be a obstacle in this route to to full decentralization and self custody of funds, because if you're still reliant on these traditional providers, and obviously how custodial are you? And I think this comes big into getting bigger players into DeFi, kind of like these questions of like how decentralized is it, or how does the security work, like all these things. And we just saw Aave launched a permission pool kind of for institutions. Super interesting there. I'm curious if you guys have kind of reached out to any institutions, or if you guys have thought about trying to bring on board like big money from big players into y'all's protocol, and like what that looks like.
I guess we haven't actively reached out to big institutions, but I just got some inbound interest from some asset managers based in Germany who are very interested in Liquity due to the high yields that people can still make there. And they have access to people like with significant amount of funds, but who are not technically or not technical enough to use a blockchain application. And they are now really interested in building some new front end or something that maybe they would even manage for their customers so that they could create this kind of onboarding facility for non-blockchain native users of our system.
Yeah, and I was just going to add on to that. One of our big areas of focus so far was, number one, getting Liquity out the door and then making sure it worked. So institutions weren't at top of the mind there. And then now we're in a situation where we're still trying to continue to grow borrow side demand and LUSD demand within the DeFi ecosystem. So a lot of that means just working on integrations, building out liquidity across various different platforms, and making sure that LUSD is kind of in all the right places, so that eventually, whenever we can pivot to sort of focusing on like institutional adoption and stuff, the infrastructure is there for them to use. Because one of the last things you want, right, is to run a pilot program with an institution, and there's no way that they could practically port that over to the real world because the infrastructure is not there for them. We've seen it happen a lot in this space where sort of somebody tries to bring an institution in because they sort of overpromised and then underdelivered, and then the deal falls through, right? And so I think that's one of the big things to consider going into the future, is just making sure that, I guess it's advice for new projects too, make sure that your infrastructure is in place first before trying to bring in sort of the big dogs, I guess, because ultimately they need to go from pilot to real world. And if they can't practically do that, then it's just not going to work out.
Yeah, I kind of see bringing DeFi to the masses in terms of people is more important for the broader community than it is to onboard a bunch of institutions right now. But without a doubt, we kind of front ran the institutions, but now we're going to kind of call on them to come buy our bags, basically, to keep the party rolling.
No, yeah, I think institutional adoption is necessary in the long run, but I think it's almost on a per project basis. So like Aave, for example, they've been around for a long time, since like 2017, maybe even before, when they used to be Ethland. So they've had a really long journey to get to this point to where they can start having those conversations. We're just really early on now, so hopefully they walked so we can kind of run, and hopefully it doesn't take 3 years for us to get to that point, because of the way that all of these projects have sort of paved the way for everybody else. But yeah, I think when we're ready, we'll eventually get there, and we can bring institutions in, and they'll actually be able to use this stuff rather than needing to have their hand held. Even in some ways, hopefully, like, there are sort of organizations that pop up that are willing to create these sort of like custody type solutions for institutions, and the teams themselves don't actually have to do that, right? They can just build out decentralized protocols while everybody else works on white label stuff on top of those protocols.
Yeah,
I think that really just like speaks to the demand that is still out there. The fact that people want access to these kinds of products, especially newer ones that provide yield on something that has already existed for a few years, like Ethereum. People want access to these projects, but they're either not technically inclined enough or just don't have the time and energy to go spend on educating themselves. The bulk of the market, being, I guess, the retail market, doesn't have someone there to kind of build themselves a custom front end and improve the UX experience to something that's more intuitive that they can use. Which I guess, is kind of like that slow trickle of demand that starts to come into the system as new projects get out there. They can iterate from the feedback that, you guys get. And then you guys are able to kind of work with these other teams that improve the UX to an extent that other people can now dive in that didn't have access before. The composability, like it just reminds me of what Uni V3 did with their aggregators. And now, there's going to be different projects building front ends that tap into Uniswap's liquidity. So,
dude, that's a crazy thought. Like, is it possible, do you guys think, to aggregate the liquidity from, if we took all of the lending and borrowing protocols in DeFi and there was a lending and borrowing aggregator, which basically used the liquidity from all of them to basically provide these institutions with massive loans and massive positions. Now, a few things that immediately come to mind before you guys answer, I think is there's obviously a lot of different tokens on a lot of different protocols. There's different stable coins on a lot of different protocols, and there's different stability fees and rates and kind of the way they're all set up. So yeah, I'm kind of curious what you guys think of that as far as a possibility for, you know, large players and to get the best rates.
Yeah, I guess we have to maybe distinguish between two types of borrowing or lending systems. Like one is the type compound or Aave, which is issuing or which is loaning out existing tokens not created by Aave or by compound itself. And then on the other hand, we have Maker, Kava, and Liquity, who is issuing its own stablecoin or own asset to be loaned out. And now those systems, they could basically mint as much liquidity as they can. Like there is no upper limit. It's the only limit is the amount of ether available or whatever collateral you accept in your system. So I guess in that sense, there is no need for any aggregator because there is already like a theoretically unlimited supply of assets that you can borrow from those systems. On the other hand, yeah, for other compound and like the pool-based systems that are matching pools of borrowers with pools of lenders, I mean, of course, the supply in a sense is limited. It could thus make sense to aggregate them so that maybe a large institution that would borrow too much from one asset could then get it from multiple providers in a sense.
Yeah, and tools I'm sort of like bullish on in that regard, I guess, are tools like InstantApp, right? That let these sort of large holders migrate back and forth between different protocols and different positions based on, you know, their risk tolerance for a given time frame or just their need to save money. So like I know InstantApp has these like one-click migrations from like maybe it's Aave to Compound or Maker to Aave or whatever it is. And so if you can sort of just provide that infrastructure for them, they can go through the best rates and stuff on their own. They're already doing that in-house anyways. They're looking at, you know, what are the best opportunities for our organization or whatever it is. And then if they have the tools to be able to easily migrate back and forth between these protocols in a few clicks, then it ultimately aggregating everything underneath doesn't really matter so much as long as there's some liquidity for them to exchange in and out of stable coins or exchange in and out of assets.
Yeah, that kind of I guess shed some more light on just how I understand aggregators, right? Because there's already arbitrage opportunities and arbitrage traders making these moves out there. And it's almost like an aggregator type of exchange or DEX or InstantApp, you know, where you can just migrate between these positions. These type of like aggregating functions are essentially just arbitraging the market. You know, automatically they're already checking for like the different possibilities. So I think something like an aggregator is definitely possible. Like you said, it's already out there. And it's really that's the thing that's kind of narrowing these margins and ultimately making the system a little bit more mature as those arbitrage opportunities start to decrease.
Yeah. And the point of the aggregator is basically capital efficiency, getting the most for what we currently have in DeFi, right? Like the whole point of using 1inch is to get the best rate so that way you can save some money, pay a little bit extra on gas costs. And similarly, you know, to this idea of lending and borrowing protocols, it basically to get the best rates, to have like the deepest, most liquid book. So it kind of seems like there would be one for each kind of subset of lending and borrowing protocols that Robert has described. And yeah, it seems really interesting. And kind of on the note of capital efficiency, one of my favorite things about a protocol called Lido Finance is they allow you to stake ETH in the kind of 2.0 proof of stake concept. And then what you can actually do is you can take the ST ETH token and deposit it into like Cream, you know, to use and to collateralize. So you basically have interest bearing ETH that is now collateralized. Is there a future in which ETH that is collateralized in Oh, excuse me, guys. Alex, check that one out.
Yeah, Liquity.
Is there a future where the ETH that is collateralized in Liquity could be used elsewhere as far as obtaining the maximum amount of capital efficiency for those who choose to use? Yeah.
So, like for the time being, Liquity is only allowing you to use standard Ether as collateral, and basically the collateral that's inside the system cannot be used inside other systems. Like that can be seen as a limitation, but it's also, I guess, something which makes the system more secure, because it's you know that you always have the Ether available. You're not rehypothecating it. But we are now looking into like new ideas or new systems which are much more broader in scope, like which would allow you basically to borrow any asset, like existing asset, not just our own stablecoin. And there we would also be much more like accepting when it comes to collateral types, and accepting some interest-bearing tokens, be it like some Lido-based staked Ether or something else like a C token from Compound. I mean, that could be like really interesting, because then you already have some interest-bearing token inside your system, like as collateral, and then you get a loan against it. And like the loaning or borrowing system doesn't even have to care about rehypothecating it or putting it in some vault or somewhere else, because it already has something as collateral which is accruing value over time. Yeah, that's something we are now actively exploring.
Yeah, and the big thing with those is just like risk isolation, right? In the current Liquity system, I mean, it's completely immutable, so we can't change it now. But in retrospect, if you think about it, like all of the risk is shared by everybody kind of in the system. And as soon as you start introducing new collateral types, that becomes a lot more difficult. If you think about the way Maker adds new collateral types, for example, they have to do pretty lengthy risk assessments across all of those collateral types. Most of them have different parameters. They have different debt ceilings. They have different stability fees. And so Liquity doesn't really, or Liquity in its current form, right, the immutable version, doesn't support all of those things. And so it just makes sense to have ETH as the sort of one asset that it accepts as collateral, the one asset that people can borrow against, and the one asset that people have to do a sort of risk assessment on, right? And that makes it a lot sort of easier to wrap your head around as a borrower or a user.
Yeah, maybe that's a good point. And one thing to add is that, I mean, we are not only a borrowing system, we are also trying to issue like the most decentralized stablecoin that's out there. And for that matter, it is a bit like critical what kind of collateral you accept. I mean, we didn't want to go down the route that Maker took by accepting centralized stablecoins, for example, as collateral, because that would render our stablecoin less decentralized. So yeah, I mean, we had like multiple goals to fulfill at the same time. So that's why we opted for being very restrictive and very conservative for this current Liquity version.
Where is a token like wrapped Bitcoin in comparison to, say, SNX on your radar as far as risk management goes? Like is wrapped Bitcoin more or less risky in your opinion as collateral type than, say, SNX or Aave token or Uni?
Yeah, I mean, it's hard because we haven't analyzed them now in detail yet.
Yeah.
But I guess like for wrapped Bitcoin, it really depends on the wrapping. Like if you really mean the WBTC, or there's RAN BTC, maybe there are others. I mean, Bitcoin itself would be like a really great collateral, but I mean, the question is how much uncertainty the wrapping mechanism adds to it.
Right.
We haven't like analyzed them all in detail, so I cannot tell you too much about that. But I mean, there are other tokens that could be interesting, like Uni, for example. I mean, of course, it's something which has a large enough market cap, or a really large market cap, because that's another aspect we need to take into account. I mean, we cannot accept something as collateral which has a market cap which is much lower than the market cap of our system, or like the size of our system, because that may destabilize the token that we want to be stable as a collateral, at least to some degree.
Yeah, and it sounds like decentralizing is another like core value when you guys look to add collateral. Ethereum being pretty much the most decentralized coin. And then, depending on the wrapping, you have different versions of wrapped Bitcoin that can be more or less decentralized than others. Hey, that makes me think of Doge. Doge is probably a really good collateral type as well.
Yeah, that will be the only next collateral type that
Ren Doge.
Yeah.
Hey, so do you guys think that Doge is going to flip Bitcoin or what?
Absolutely not. I think. Well, actually, I say that, and so now it's going to happen. But it's one of those things where, like, I mean, these market cycles happen quite often, and so everybody thinks everything's going to flip Bitcoin at some point, and we always never get there. I think if any asset has a real chance of flipping Bitcoin, I'm not biased or anything, but it's probably going to be ETH. I just think the Ethereum network has grown to a point to where it's outpacing Bitcoin in so many different metrics that it's like almost laughable at this point that they're not closer in total valuation. And so, yeah, I don't know. We'll see how the market plays out and how these things go. But
think about this thesis though, Colton. If ETH passes Bitcoin, what's to say Doge can't pass Bitcoin?
Yeah, I know. I listened to a recent Bankless episode where Three Arrows Capital were making that same argument. I think
that episode would be so bullish,
it.
bro. That was such a top signal. That entire episode was like such a top signal.
No, yeah, and I maybe I agree with it. I don't totally know. It's an interesting point, but people brought up on Twitter even this morning about how if Bitcoin fails, then the whole space fails, and I think that's just like fundamentally untrue. Mostly because Ethereum has created a lot of separation between itself and the rest of the space to where, everybody is competing with Ethereum and nobody's competing with Bitcoin anymore.
Yeah.
So it's just hard to make that case. But yeah, I guess we'll see.
Yeah.
That point aside, like whether it kind of creates, whether it kind of brings the whole market down with it, if it does fail, is anything under like the number one crypto failure for Bitcoin? Is there like a certain market cap, or is it just like Bitcoin has to be the most expensive cryptocurrency for it to be successful?
Yeah, I don't agree with that at all, right? Like, who cares if Bitcoin's number 3 or whatever? Like, that's like being mad that, I don't know, the internet like surpassed gold or like, the value of the internet surpassed gold or something. It's kind of like trying to make that argument, and like gold never died, right? Gold is still around. Robert, I don't know if you have thoughts on this. We're kind of waxing poetic on the philosophy of this stuff.
Yeah, just assuming that Bitcoin will never change its like proof of work algorithm, I guess that this could become an issue for them. Like at some point, the environmentalists would probably, or many people would probably prefer more environmental friendly alternatives, be it Ethereum 2.0 or Dfinity or other systems. So I'm not sure like whether this power, like proof of work based mining has like a future, like a long-term future. Maybe it will be very prominent in the next few years, but like in 10 or 20 years from now, I have big doubts.
Yeah, and not to mention, like, I know the Bitcoin maximalists like to, I'm trying not to be offensive, they like to pretend that everybody really cares about this 21 million number. But at the end, if you ever talk to a normal person, I promise you, they do not care about the total supply of Bitcoin. The normal person thinks Shiba coin is cool because it's like going to the moon, right? So like we have a long way to go before the mass population is worried about whether or not there's 21 million units of a particular currency or something. I would much prefer the model that ETH takes, for example, where they do sort of minimum viable issuance and make sure that the network is fundamentally secure. They make sure that ETH is a productive asset, and they make sure that the network actually has serious adoption and innovation and research taking place on top of it. And so I don't buy into the idea that Bitcoin fails, everything else fails, because if that's true, then what are we doing all of this for? We might as well pack it up and go home now and just see what happens with Bitcoin.
Yeah, I think the largest issue with ETH is like the gas fees and stuff, but that's just a testament to what Kyle Davies was saying on that same podcast as far as just pure network activity and effects, and that the high gas fees on ETH is almost extremely bullish for ETH, based off how many people are willing to pay these fees, to use the network. But that brings us to the question of layer twos in this DeFi summer that I'm pretty sure that we're about to embark on here as we get going with layer two. So I think Arbitrum's coming out the 28th, I believe. And then I think Optimism is sometime relatively soon. We got Polygon popping up, and a bunch of other chains are doing well as well. What's y'all's overall take on L2 for the current ETH DeFi ecosystem? Like a more specific question is like, when is gas going to be solved? Like, when is this going to be solved?
It's hard to say when this will happen, or whether L2 will be the savior for the gas costs, or whether it will be ETH 2.0. But what I can see is that, we now have, as you said, a few options, and which is not necessarily the best thing, because I guess you not only need to have a technical solution with lower gas costs, but you need a system, or like a layer 2 network, which allows to communicate with, which has an ecosystem of its own. Because what we have seen with those optimistic rollups is that whenever you have to go back to the main chain, you have to wait 7 days or something, and that's not usable. So the only way to make it usable is by creating an ecosystem on your layer 2 solution, and fragmentation doesn't help there too much. But I guess every system that somehow moves away from the main chain already helps the remaining protocols or applications on the mainnet to be more gas efficient, because as the transaction load diminishes, you can also benefit from that. So even by staying on the mainnet, you may benefit from a gas cost decrease.
Yeah, and from a Liquity specific point of view, it's not as easy for us to just deploy Liquity on every single L2, maybe as easy it is for a DEX, for example, right? They can kind of just deploy on every single L2 and then let the liquidity build up there. For us, there's a lot more things to consider before deciding if we want to launch Liquity on an L2, and then what that looks like, just because of the way that Liquity is designed when it comes to the stability pool and redemption. There's a lot of economic mechanisms at play that, if they're not sufficiently supported, could maybe introduce instability to the system, and we want to avoid that, right? So we want to make sure that if Liquity is ever launched on an L2, that it makes sense for Liquity and for the rest of the ecosystem. And there also has to be just other stuff there, right? You don't want to deploy a system to a barren wasteland, essentially. So it's nice for us to just kind of watch how the L2 ecosystem develops, or the sidechain ecosystem develops, and kind of see where the liquidity goes, see where the users go, maybe even see how some interoperability between these sort of ecosystems goes. And then if we want to make a decision, make one from there. But, I think if any ecosystem more broadly can figure out the gas fee situation, it is the Ethereum ecosystem. The amount of research and innovation going on in this space is crazy. So I don't doubt that we'll have it figured out to some extent in the near future.
Do you guys, and I guess this is kind of fast forwarding through the L2 race, since you guys y'all aren't super concerned about it, because like you said, there's a lot of things for you to consider. And it's not like, just popping out on every L2 is gonna benefit Liquity. So kind of fast forwarding through the initial L2 phase, which I really see as kind of the next few months leading up to ETH 2.0, I think is going to be the kind of L2 season, if you will. As ETH mainnet still has significantly higher fees, the L2s are really going to flourish. But once we eventually do get to ETH 2.0, I expect L2s are going to have a little bit less volume as the main chain kind of has some lower fees. How does that affect Liquity? If people are staking their ETH on, in a validator node to gain those types of fee rewards, do you kind of expect some drops in liquidity on Liquity? Maybe kind of speak to the consequences of ETH 2.0 when it comes to Liquity.
I can definitely see some kind of competition by ETH 2.0, because due to the staking reward mechanism, you now have a new player or a new way of earning yield on your ETH. though it's a little bit different because like with staking, you always have those penalties like that you may face if something goes wrong. So it's not risk-free at all. While in our system, like as long as our system is bug-free, essentially, like we can offer risk-free yields. Like risk-free in the sense that, of course, if you stake LUSD, for example, the stability pool, and the LUSD should like always be stable because it's really designed with this like kind of hard peg mechanism. Like it cannot become really, it cannot depreciate while you get like the LQTY tokens in return. So that's like a risk-free yield on your ETH. It may not be as high maybe in the future as the yield that you could get on your ETH too, but I mean the staked ETH, but I mean it also has different risk parameters.
Yeah, and yeah, that was the point I was going to go into, is that there's going to be different types of users with different risk appetites, with different interests in how they want to like go about earning yield or doing whatever else. And so for some, like borrowing or leveraging up might be the way they want to do that. For others, it might be staking in ETH2. For others, it might be just lending out their ETH on something like Compound or Aave. You never know, right? So there's always going to be various types of users. Fortunately, if Justin Drake's sort of ultrasound money beam continues to take off, the value of ETH appreciates over time. And that means just because more ETH is getting sort of sucked into all of these different sort of liquidity black holes, the price of ETH goes up and people still have more borrowing power per ETH. And it doesn't matter if the amount of ETH per se is less inside Liquity, but the dollar amount is higher. It still ends up being sort of beneficial for Liquity in the long term, just because people can continue borrowing against their appreciating asset. But yeah, I think it just depends on how all of that stuff develops. And as more people stake in ETH 2.0, the yields there go down. I mean, I think even now it's at like 7% or something like that. And, if people just continue staking, then it's only going to go further down up to a certain point. And so, people are going to want to capture opportunities elsewhere, and they can do that through Liquity by, borrowing against their ETH, using LUSD to hopefully in the future lend it out or provide liquidity on Curve or do whatever they feel like doing. So yeah, I think we'll be fine. I think everybody will be fine when it comes to where ETH is going to be allocated, just because the ecosystem is going to keep growing. Not everybody is going to want to stake. There's a lot of overhead there. And not everybody is going to want to take a yield haircut by depositing through a sort of custodial solution like Coinbase or wherever else.
Nice. Yeah, so it sounds like the DeFi flywheel, in your opinion, just kind of continues to perpetuate on with the ultrasound money thesis. ETH becomes a deflationary asset. So just because the ETH amount itself is going down, assuming that the price keeps going up, there's actually more value being staked, which is healthy for DeFi as a whole, because more collateral means more borrowing opportunities, more borrowers mean more buyers, and then more buyers, mean prices go up because people are buying. So that's kind of the idea behind the DeFi flywheel, and it sounds like ETH 2.0. Although it might fragment liquidity a little bit, it's not going to silo this liquidity in a way that's going to prevent composability and just consistent lending and borrowing throughout the entire ecosystem.
Yeah.
So yeah, I mean that's certainly healthy, and that compounded with the reduction in gas fees, ultimately just reduces friction in the system.
Yeah, and that's what I mentioned like earlier. I mean, we are also now exploring like new ways or new systems that could accommodate other collateral types, including like staked ETH derivatives, and which would allow you to have the best of both worlds in that sense.
Yes, staked ETH derivatives are a killer app, I think, and will eventually probably be a killer collateral.
Yeah, definitely. I mean, that's like one of my favorite collaterals on Aave right now is X Sushi, because it's sushi that's earning like 10% a year, 5% a year, and then you get to collateralize it. I mean, it has an awful LTV. It's like 25% as far as your capacity for borrowing goes, but ultimately, yeah, interest-bearing collateral assets are I mean, amazing. And then if even more so with this flight to L2s, if you can get interest-bearing collateral assets, and also you get a liquidity mining reward on top of like Aave on Matic for example, right? Like these are these collateral opportunities are something that I think like these institutions that we were speaking of are like going to froth at the mouth at, because it's like it's not available like this elsewhere. Like there's just nothing. So I think that's something that's super exciting. Speaking more towards what you guys are building, what's coming up for y'all in the rest of 2021? What are you guys trying to accomplish?
Yeah, so there are different things there. Maybe Colton can tell a bit more about like our integration efforts, which are centered around like the current protocol version. But as I mentioned, we are already working on something new. I cannot tell you too much details because it's like still under development and it's in a very early phase. But what I can tell you is that it's like about borrowing against multiple collateral assets, and the things that you borrow would also be existing assets. So you could theoretically borrow any asset against any other asset, interest-free and at a very low collateral ratio. So that's the value proposition. Of course, it's not as easy to achieve. So that's why we now started like with our simulations to just see like whether our early ideas work out or not. But they look kind of promising.
Yeah, and just to add another disclaimer to that, when we say early, we mean early, like really early. But anyways, for like, I guess for the rest of the year, on sort of my end of things, like we're really focused on just continuing to grow LUSD adoption, because ultimately that grows borrow side demand option. And the other part of it is just raising awareness. So really focused on integrations, really focused on getting LUSD into the hands of more people. Part of that means like, getting listed on different money markets, whether it's Compound or Aave, but also making sure that we're available on various DEXs, making sure that there's tooling and infrastructure available through things like InstantApp or DeFi Saver or Zerion or wherever else. The other side of it is just continuing to grow our sort of front end ecosystem and making sure that our front ends are sort of, moving the needle forward as far as like what tools they offer, the looks they offer, the sort of features they offer. And then the sort of last side of that, I guess, is just the marketing side. So continuing to raise awareness of Liquity more generally. One of the things that, it's no secret that, one of our biggest, I guess, competitors in a lot of ways is Maker. And, whenever you're going up against somebody who's so large and it's been such a mainstay in the space, you have to make sure people hear about you. And so we'll be focused on a lot of various marketing efforts sort of going into Q3 and then hopefully into Q4. And then especially at the turn of the year, we'll be ramped up pretty big in that regard, just making sure people know what Liquity is.
Sounds awesome. Looking forward to seeing the growth and being an active player in the space with you guys. Great podcast, guys. Thanks a lot for coming out. Any closing thoughts, Rob?
No, man, this was super. And I think we covered a lot that is just pretty helpful to the space and newer members as they come in, as well as kind of more experienced guys that have been here for a while. With some of the different products that are coming out now, especially that synergize a lot across the ecosystem, aggregators, bridges, and things that kind of go cross chain. There's plenty of opportunities out there, like arbitrage opportunities and different staking opportunities. I mean, my advice, I guess, is just don't be afraid to, test things out. Obviously do your own research, but there's so many different niches in the ecosystem now that to kind of crawl into one of them and stay put, I think, is really damaging to someone's growth as like kind of a degen, and a DeFi degen. Like you got to keep learning. That's the name of the game.
No, yeah, that's totally true. And, I've had, a lot of, I guess, real life friends come up and, ask how to get involved in the space and stuff. And literally the best way nowadays is to just get your hands dirty, listening to podcasts like these, going and reading blog posts, keeping up with all the newsletters, hanging out in Discords. If you're doing all of that, before you know it, you'll be pretty embedded in the space. And who knows, you'll probably end up with a job somewhere because, there's too much demand and not enough like talent all around. So, if you're looking to get into the space, there's never been a better time, I don't think.
There's just so much going on at the same time, so it's really amazing. It's hard for those newcomers a bit because they have to learn not just one thing, but like they are immersed in a whole ecosystem where the target is moving all the time, and Yeah, but that makes it also like appealing, I guess, to many people. It's this like learning process that never ends.
Yeah,
It's,
you never
you
have to
new-
get off the treadmill in a way. You're just kind of always running for the carrot. But it's super rewarding. So I definitely recommend anybody who's like had thoughts about trying to get into the space and get involved, just dive in head first and see what happens.
It's all about the drive. Who cares where you're going?
Yeah, exactly.
All righty, gents.